Transferring wealth successfully starts with asking yourself questions that will give your family a better life now and for generations to come. In this podcast, financial experts John and Michael Parise from Copper Beech Financial Group guide you through eye-opening questions to help you discover the truth about your wealth. Now, on to the show.
Hello and welcome to The Truth About Wealth with John and Michael Parise of Copper Beech Financial Group. I'm Wendy McConnell. Well, we have a house full today, guys.
Yeah, party time today, Wendy.
Yes.
On a Monday at that, right?
Exciting.
Yeah, kicking the week off really well.
All right. So who do we have and what are we going to be talking about today?
Well, we have two guests actually today, but Mark Sims and Aaron Quinn from Madison Insurance Group. How you doing today, gentlemen?
Wonderful.
Doing well.
Happy Monday.
Hey, guys. Always good to see you both.
Yeah, thanks for being a part of the podcast. Mark, you are a kind of an original guest, I think, all the way back in
Been a while.
gosh, 2019 or 2020, I think it was when you first
And I still have my hair.
came. You were one of the first guests. Yes, you're still your hair is still in place. That's good. So, well, I appreciate you guys for being a part of the podcast. I again, as we said, Mark, you were on the podcast quite a few years ago, and we thought, well, there's some things that I know you'll get into on some recent IRS regulations on your program that I think are really important to for our listeners to hear. But I also just thought, in general, it would be a really good time to get you guys back on the podcast to explain what you do at Madison and how you can help business owners. It's a strategy and a tool and a company that we've worked with for a long time. I think we go back with you guys all the way probably 15 years, I think, at this point. So gotten to know you guys really well. Not only great people, but a great company. So we're excited to have you on here. But maybe, Mark, why don't you take just a quick moment, introduce yourself, your background, and what you guys do at Madison.
Sure. Thank you, Michael. Obviously, it's always an honor to be able to speak to you guys and work with you guys. It has been at least 15 years, if not longer, but it just seems like yesterday, right? Madison Insurance Group is a consultancy company. We basically operate a couple of insurance companies. We have a direct writer that is a licensed property and casualty insurance company in the jurisdiction of Puerto Rico. That name of that insurance company is called Madison International. Madison International is authorized to insure for businesses enterprise risk coverages. Enterprise risk coverages are risks that businesses have that if they happen, they could interrupt their revenue. And so these types of policies can insure against the loss of the revenue and any of those types of risks. Some of these risks are like loss of a key contract, a key customer, loss of key talent, not to be confused with key man insurance. That's usually funded with a life insurance policy or disability insurance, and you have to die or become the key person has to die or become disabled to pay out. This is more if a business loses anybody that they consider to be key talent in their company, and the loss of that talent causes the company to lose revenue. That's what these types of policies will insure against. Supply chain interruption, cyber risk, which is a big one, a lot talked about. Some of them which aren't talked about a lot are reputational brand or goodwill, administrative or regulatory actions. If a business is ever audited or investigated by any federal, state, or local agency, there's got to be a cost to defend that. That would be reimbursed with regards to those types of risks as well. So these are risks that happen with a company that are low probability to occur. All right. But if they do occur, the claim is usually pretty severe. And if you think about how insurance companies in general make money, is they collect their premiums from their insured participants. They allocate so much to their overhead. They allocate so much to claims. And whatever's left over in the insurance company after expenses and claims is called underwriting profit. And insurance companies take their underwriting profit and they invest it with the Goldman Sachs, the Morgan Stanleys of the world. And that's how they make money, off their underwriting profit investment income. So the main reason businesses don't typically buy these types of coverages from your traditional commercial carrier, one is their low probability to occur, and 2, they're really expensive to buy. And for those 2 reasons, business owners will choose not to insure these types of risks, because if they bought these types of policies from that commercial carrier and they did this for a number of years, they get to transfer that risk to a third-party carrier. That transfer of risk is a necessary and ordinary business expense. But if they did that for a number of years and they managed their risk and had little or no claims, the insured does not get that underwriting profit and investment income back. The commercial insurance carrier keeps it. So in the Madison program, the difference between the Madison program and buying this from the Madison International Insurance Company is there is the opportunity for the owner of the business to participate in that underwriting profit investment income at some point down the road if they mitigate and have little or no claims. And how that works is the insurance company will reinsure those risks to the second layer of insurance company in this program, Madison Re. Madison Re is organized as a protected cell company. It also is domiciled in the jurisdiction of Puerto Rico. And the main reason we're there is because of the statutes and laws that have this type of insurance company and the protected cell statutes there. Madison Re, a licensed reinsurance company, is organized as a protected cell reinsurance company. And all the premiums that the business pays for those policies that they purchase from Madison International will ultimately flow down into that segregated account. That segregated account basically operates as a funding mechanism for claims for Madison Re. So if the business had a claim on any one of those policies, it goes through the claim adjudication process, it gets approved. Madison International is obligated to reimburse the business for that loss, but that they reinsure that down to Madison Re. Madison Re then will send the funds for that claim. 50% of that claim is funded out linked account. The other 50% is paid by Madison Re's funds without a risk reserve or their pooled account. All of that basically means is that the entire program is operating as a bona fide insurance company. And so the ability here is that those premiums will flow into that linked account. The premiums stay in that linked account after expenses are paid, and the assets inside that linked account get invested and will earn investment income. So the underwriting profit and the investment income that the business pays ultimately will sit in this separate account that links back the policies and premiums that the insured business paid. That linked account is owned by the reinsurance company Madison Re. Madison Re has all the ownership rights to that account to fund its claim liability and any taxes paid to the Puerto Rico jurisdiction. But outside of that, the ownership of those assets in that segregated account can be linked back to the owner of the business or somebody or some entity in the same economic family of the owner of that business. And that's why we have such a great relationship with Copper Beech, is because a lot of the insured business owners don't know who should get the ownership rights to that underwriting profit and investment income, or maybe they want to have some options for it to go to somebody in the same economic family of the owner of the business. And that's the opportunity for Copper Beech. And what they do is on the exit planning inside of this program. So what this becomes and what Madison Insurance Group has here is the ability for a total risk mitigation program. First and foremost, the insured business is going to mitigate against these low probability, high severity risks by insuring and buying these policies from Madison International. And these are types of risks that really keep business owners awake at night. Losing a key customer, having a supply chain interruption that will interrupt their revenue, having a cyber attack, having somebody come in to the business's computer system and hacking their system and taking all their data and then demanding, and they'll give it back if they have a ransom, they pay them a ransom or ransomware. Most commercial insurance.
So Mark, real quick, Mark, you must have had an issue with COVID. You must have had a lot of policy or claims through the COVID period for those factors. And a lot of people didn't anticipate that happening, obviously. But if they had a policy with Madison, they would have been protected. Am I correct?
That is correct. That is correct.
Wow.
although a lot of our clients fortunately for us in this program, we weren't insuring the airline industry, we weren't insuring the hotel industry and the entertainment industry, where those industries suffered for COVID. People didn't travel and go on vacation. So what they do, they spent money remodeling their house, doing their land. So our clients actually had a good year, but we did have some clients where they lost key talent during COVID. And so some of those policies were reimbursed back to the business owner for losing that talent when they lost revenue for that talent going somewhere else.
All right. So basically, a business owner could buy a policy with Madison on all different type of risks that they have as an industry. Because full disclosure, we have a policy with Madison, or policies with Madison, and been doing it for 10 years plus. So we have our own program, but we buy policies to ensure our risk in our industry, and they're all different. So you do an analysis on the risk in each industry, what's available, or what policies that company should buy potentially to protect their risk. And when that money flows to Madison, you insure that risk, and it ends up also, if there's no claims against that pool, Copper Beech as a company would keep that underwriting profit, and then it starts all over again. I'm trying to keep it simple for listeners. So it's really a way to create a nest egg for the company, cover your risk. And my understanding, as you know, in Puerto Rico, because it's not the IRS, it's the hacienda. I love that name. That's a different tax structure. It's a treaty. You want to walk people through the treaty aspect of the benefits of managing money in these structures?
Yeah, sure. So Puerto Rico obviously is a territory of the United States, right? They're under U.S. federal law. They're under U.S. customs, all of that. Their residents are United States citizens, right? But the uniqueness—
They are Americans.
They are Americans. But the uniqueness of Puerto Rico, and this dates all the way back to 1952. That's when the United States Congress granted Puerto Rico as a territory or Commonwealth of the United States the ability to govern themselves. And so basically what that means, and in particular to what we're doing at Madison, is first and foremost, Puerto Rico has their own insurance laws, right? And so the Puerto Rico OCI stands for Office of Commissioner of Insurance. That's their Department of Insurance, allowed for this type of protected cell structure to be written out of Puerto Rico. Puerto Rico has I will say that Puerto Rico is the only non-U.S. state outside of Washington, D.C., to be an accredited member of the NAIC. So that's a very robust, rigorous regulatory body in Puerto Rico. They have their own corporation laws over there. So the insurance companies are not over there. Madison International Management are not C corporations. They're not S corporations. They're Puerto Rico corporations. And the benefit to that is Puerto Rico, they have their own taxing authority over there called, as you mentioned, John, the Puerto Rican hacienda. That is their internal revenue service. All right. And the Puerto Rico hacienda governs the taxation of Madison Re and these individual segregated accounts. So there's a low tax friction with regards to how the underwriting profit and investment income is taxed in Puerto Rico.
Mark, one of the things that I always like to hear you guys talk about is the process. If a listener to this podcast wants to give you guys a call and explore the process that you all go through, what does that look like? What documents do they need to collect? What do you need to see? And I think you call it the feasibility study. Explain to our listeners a little bit about what that looks like and how that process operates.
Well, so these are licensed, regulated insurance companies. They have these industry standard policies that they issue. And how do we know which policies a business is eligible for, the risk they may have that they can purchase from Madison International is we do take them through an underwriting process. The insurance company has licensed underwriters, and the information we gather is first and foremost, and probably the most important piece, is what we call the risk assessment questionnaire, or the application, if you will. The insured business completes this risk assessment questionnaire. It's going to ask about the demographics of the company, where you're located, what's your revenue, all that. And then we're going to ask specific questions. Do you have key customers? What percentage of the revenue is that key customer? So on and so forth. So the risk assessment questionnaire helps the underwriters and the actuaries who actually determine the risk and the premium determine what the business has that they could purchase through Madison. We also do look at some of their current commercial policies. The policies we don't write primary layers are like general liability, commercial auto, commercial property, commercial workers' compensation, but we can do deductible reimbursement. So we want to look at those policies if you have deductibles, or they might want to take on a deductible. So that's why we look at the current commercial policies and their business's financial information. Why do we need their financial information? We're insuring loss of revenue. We got to know what the revenues are. So all that information is gathered during the underwriting process. The underwriters will scrub through it, make sure we got everything. Once that's done, then they will send that out to outside independent licensed actuaries who will then determine the different policy limits that can be insured, that the insured could buy, and the premiums for each one. So our goal is that we want to say, here's everything that the Madison International Insurance Company can insure you against. Here's all the policies. Here's the different limits, and here's the premiums for each one. And we allow the business then to direct pick and direct procure directly from Madison International from that list.
Yeah, that's great. And maybe this is more of a question for you, Aaron, because I always like to hear you talk about like what is insurance, and that's, I think, a really key question that makes your structure work. It's not, you can't just open up a company and call yourself an insurance company and try to issue policies, right? I mean, there's a process that has to be done. Not only do you have to be licensed as an insurance company, but explain a little bit about how this arrangement qualifies as insurance, and what does that mean? Because I know there's a lot of different definitions for it.
Sure. So insurance, really, to achieve an insurance or an insurance transaction, right? There's essentially two legs of the transaction. First is the regulation side. Insurance is a regulated industry, and by regulated industry, I mean it's an industry that is specific to really the economics of any society, kind of similar to banking, similar to natural resources development. Insurance serves a purpose in society, right? And in doing so, insurance allows folks or entrepreneurs or businesses to take risks that they otherwise wouldn't take, right? So in that realm, insurance is a very regulated industry, and to have an insurance transaction, you have to go through the regulations, right? The regulations primarily are capitalization requirements for the insurance company, approval by the jurisdiction or the domicile that is hosting the insurance company, all of the really processes that can be completed more or less with paperwork. Okay, that's half the battle for an insurance company or an insurance transaction. The other side of the insurance transaction is more of the economic side of the transaction, right? Things that need to be achieved or must be achieved not simply by filing pieces of paperwork. And what I mean by that are if the substance of insurance is more or less to make losses more predictable for the insured and the insurance company, right? More pooling losses, sharing losses, right? The only way to achieve that status is through having enough insureds and having enough risks and having enough insurance premium. Okay, more or less can be boiled down to mass. Okay, and then also homogeneity within that mass. So any sort of insurance transaction, first, you have to meet the regulatory requirements, and then second, you have to meet the economic requirements. Otherwise, it's not insurance, right? You can have one or the other and purport to be insurance, but without both, you're not going to meet the insurance test. And that insurance test is from essentially all levels of regulation, right? Whether it's insurance regulation and non-insurance regulation. The benefit with Madison, obviously, you just heard Mark there talk about the regulatory system within Puerto Rico and all of the licenses and the hoops that Madison jumps through to become a regulated insurance company. But the benefit of Madison is that it actually does have this economic size, right? It does have the mass, it does have the homogeneity to constitute insurance outside of the regulatory system. And that's very, very important because relatively speaking, it's not difficult to to comply with the regulatory aspects of an insurance company. And we see that a lot with the smaller insurance companies, the insurance companies that are owned by the insureds, which are more or less coined the term captive insurance companies, right?
Right.
And it's relatively easy, right? But to actually make it insurance, you have to have a sufficient number of insureds who are similarly situated with similarly situated risks. And that is what Madison has that helps it in its definition, its economic and legal definition of insurance.
Hey, Aaron, as an attorney / CPA, you and I both know when we present this program to our business owners, they love the concept, and we get to their advisors and they don't really understand the structure. And I know you were very much involved with figuring out how the IRS looks at this, because the IRS does get involved as a U.S. taxpayer on the strategy as a business. Walk through what's happened over the last 6 months on not only the industry of captive insurance, because that's a buzzword to the IRS. This is not insurance captive. Madison's different, but walk through what's occurred over the last few months.
Sure. So over the past 30 days, no, a little bit more than 30 days, we finally, as in practitioners and participants in insurance transactions, we finally received the final regulations put out by the IRS, which define certain insurance transactions that the IRS thinks are either subject to abusive or potentially abusive. Okay. The regulations put up by the IRS in this regard are not saying whether our specific transaction is or is not insurance. All they're saying is that these certain subsets of insurance transactions, and I'll discuss which subsets those subsets of insurance transactions do have the potential for abuse or are abusive based upon a certain set of facts. Okay. And the subset of insurance transaction that we are discussing here are the micro captive insurance transactions. Okay. You heard me speak a little earlier about a captive insurance company, which is essentially an insurance company owned by its insureds. Captives have been around since the 1950s. Virtually every Fortune 500 company has its own captive. If you think about how captives have evolved, I mean, take a look at Allstate Insurance Company. Okay, Allstate was Sears Roebuck's captive at one point, right? So captive insurance companies have been around for a long time, and economically speaking, captives work really, really well from a legal standpoint and an economic standpoint with big conglomerates, big controlled groups where have a lot of different risks, a lot of mass, a lot of homogeneity amongst those risks. Those are very popular and those work well. What we've seen in the industry over the past 25 years, though, is this hybrid of the captive called the micro captive, right? Which, if you look at captives are limited to the insured and the insured's owners. A micro captive is more a smaller subset of a captive, right? And the substance of the micro captive is that it does all the same things as a captive, but it is very limited in first whom it can insure, and second, the level of insurance premium it can receive per year. So much so that its inherent limitations have caused or have promoted a lot of abuse in this captive insurance field. And that's what the recent IRS final regulations are attacking. And what do I mean by that, right? Well, a micro captive insurance company, if it's trying to, you could meet all the regulatory requirements of forming a micro captive insurance company relatively easily. There's a lot of reputable firms in the market that can assist you with that. But the economic side of a micro captive insurance company, because of its premium limitations, which I believe are about $1.8 million right now per year, as well as the number of insureds it can actually insure, those limitations prevent more or less micro captive insurance transactions from constituting insurance in the type of insurance that the government, the IRS, the Department of the Treasury, allows taxpayers to take a deduction for, right? So if you go back to what I mentioned earlier, that insurance is fundamental to a society. It's fundamental to entrepreneurship. It's fundamental to commerce, right? In that vein, the Department of Treasury and Congress and IRS want businesses to buy insurance. And we know that because the government, by way of section 162, allows for a deduction for a payment of insurance premiums, right? Anytime you see something in the tax code for which there a deduction is allowed, it's because Congress and the government wants or encourages those activities. And the same is with insurance. However, you have to actually be purchasing insurance, right? And what the most recent final regulations did is they essentially outlined transactions that the IRS believes are not insurance, right? The transactions amongst these micro-captive insurance companies, micro-captives being those insurance companies with a specific tax election under Section 831B, outlining these transactions where there is lacking mass, there is lacking homogeneity. Regulation could also be lacking as well, but regulation is not the only requirement. And what the IRS has done is they said, hey, we're not saying that these transactions aren't insurance, but we are saying that we think that they're subject to abuse, and we want those participants to essentially disclose their participation in these transactions by filing a certain form with the IRS. Okay, now, myself as a tax practitioner here, right? If I look at this rule, there's nothing in this rule to say, hey, you can't do those microcap transactions. All you have to do is file a specific form. But I'll tell you what, if you file that form, I can guarantee that within a matter of months, you will receive a letter from the IRS opening up an examination into into that transaction, right? And the way the U.S. tax system works is that the burden of proof is always on the taxpayer, right? The government's determination as to any transaction is presumed correct. So those participants in those microcaptive transactions, they are going into a battle with the by disclosing under this final regulation, which they have to do. You have to disclose when it's a very, very steep penalty if you don't disclose. So you have to disclose. By disclosing, you are essentially going into battle with the government and a stacked deck, right? By stacked deck, I meaning is in the government's presumption or is already presumed correct. The government's determination is presumed correct. So the burden is on you to disprove. And that's very difficult to do. In that vein, the difference between the Madison program is that there is no 831B election in the Madison program. There is no micro captive in the Madison program. And frankly, there's no captive in the Madison program. And the reason why is because no insured owns any Madison Insurance Company. That right there negates the definition of captive. There is no 831B election. That right there negates the definition of micro captive, right? And the size and the mere size and history of Madison allows for the necessary homogeneity and mass that is inherent in insurance economics.
Yeah, it's amazing the transition we've been watching for the last 15 years develop, and I'm so happy it's where it is now because it's been very challenging as you as a practitioner doing, explain this to CPAs that are not familiar with it, and trying to walk them through the risk of this. And the Madison program is a very, very solid program, and that's why we recommend it to a lot of our families. Talk briefly, Aaron, on the ownership structure, because we live in that world, and Mark mentioned it earlier. Talk about the benefits of having a Madison program in Puerto Rico from an estate planning standpoint.
Sure thing. So one of the primary benefits of the Madison program, I think at least, is that an insured is not in the insurance business. Okay, when you have a captive or a micro captive, you own the insurance company. That means you have to have your own actuaries, your own claims administrators. You have to have audited financial statements that you have to work to prepare, right? A lot of those regulatory burdens are expensive, and especially in the small insurance space, they really kind of eat into your underwriting profits. So that in and of itself, and the Madison program, that Madison handles all of that because it's Madison's both insurance companies here. That is a big saving grace from a headache and paperwork standpoint. But from an estate planning standpoint, right? I mean, as you heard Mark discuss how the Madison program allows the insureds or someone within the insured's economic family to participate in the underwriting profits of their own risk, right? Well, that participation is all done within Madison and the Madison insurance structure, right? So as the participation in the Madison structure builds and grows years after year after year of insurance premium, right? These assets, these investments are not owned by the insured, right? They're owned by Madison, right? Madison links back these investments and these insurance premiums to the insured by the way of a derivative contract, right? A call option, but there's no outright ownership of any cell, anything of Madison here that would be otherwise includable, right, in an insured or someone related to the insured's economic family taxable estate, right? And at the same time, having a participation in the Madison program, right, allows an insured to more or less take assets out of their taxable estate by way of a tax deduction, okay, into the Madison structure or into the Madison protected sale and insurance structure that they otherwise could not do because of certain things like, lifetime exemptions, right, gifting limitations, things like that. So using the Madison insurance structure as an estate planning tool, right, to essentially place assets and let assets grow with reduced tax friction because of the Puerto Rico regulatory system, keeping the assets out of the insured or the insured's economic family's estate, and also for asset protection purposes, it's also very beneficial, right? I mean, Madison is an insurance company. Okay, we've already talked about how these assets, the premium, the investments on the premiums grow within Madison, which means they don't belong to the insured, right? You don't own them until you exercise your call option, your derivative rights, which means they obviously can't be subject to the claims of creditors. But also Madison, as an insurance company, one that's respected and organized under U.S. federal law, is exempt from U.S. bankruptcy. Right? Madison can never be, the assets of Madison can never be commandeered or directed by a trustee or a bankruptcy court to solve the claims of third-party creditors. So it's an extra layer of protection on the asset protection side that supports the estate planning mechanisms that Madison has to offer.
All right, so bottom line is you whatever premiums you put into the Madison program, you get the 162 deduction, which is wonderful. It grows inside this structure, I believe, at the highest rate of 4% at
Right.
this point in time. And if you structure it properly, it's out of the estate for the owner of the business. And if you've structured even at a higher level, you could take it out tax free when you ultimately liquidate your segregated asset plan.
I mean, think about the Roth, right? Think about
Right.
the Roth. You can exit if you have the Roth owning the derivative contract here. This is just another way of supercharge funding a Roth, and so that when you exit the transaction, there's no tax due on the exit because the derivative contract is owned by the Roth.
Correct. Yeah. It's a very tax efficient structure, which is the point I'm trying to get to. If you look at it the way we look at it, it's also a generational structure because you could really keep this in trust if it's owned in trust for the generations to come, all very tax efficient. So we look at the Madison program as a key element to business succession of value in a certain way. You're taking money off the balance sheet of the company, getting an income tax structure to it, and let it grow very efficiently and get at a state it could be a very, very large asset for families down the road. That's the point I'm trying to make.
And that's correct. Yes, absolutely. Yeah. I mean, the one of the benefits of the Madison structure, probably from Mark Sims alluded to this too. I mean, first and foremost, the Madison structure is an insurance transaction, right? I mean, you are having risks that are not otherwise that are not currently being covered in the market that are very, very severe if they were to occur, and so naturally they are expensive, right? But what you are essentially doing is, outside of the insurance transaction, is that you are more tax efficiently funding your investments. You're more tax efficiently taking assets out of your estate plan, right? And when I say how is this being done tax efficiently? Well, two ways, right? The first is the 162A deduction on the funding or the payment of the insurance premium, but also, John, like what you said, is the maximum applicable tax rate to the investments in the structure, right? And that tax rate is 4%. And the reason why it's 4% is because the structure is governed under Puerto Rico law, and there's very specific exemptions from U.S. taxes for Puerto Rico corporations and entities that engage in the structure, right? And a final comment on this is that if you look at this, why is it so tax favorable, right? Well, it goes back to what I said at the earlier part of my conversation, where insurance is a regulated industry. You cannot tax and overtax an insurance company because it will defeat the purpose, right? Insurance companies are supposed to have their assets available to pay claims. Yes. They can't consume their assets in taxes, otherwise it would not support the economic spirit or the entrepreneurial spirit that it's designed to do. So really, the Madison Insurance transaction, in my opinion, is doing everything that it's supposed to do and it's allowed to do, right? The government wants people to take take insurance policies out for risk coverages that Madison insures, right? Madison is using its preferential tax rate to preserve its assets to pay claims.
Yeah, and guys, I think this has been great. I think we're running out of time, unfortunately, but I did want to maybe turn it back to you, Mark, and because and all this has been great conversation, but I wanted to talk a little bit about the claims that Madison pays, and maybe a story around how one of your participants maybe made a claim to a loss that they suffered in their business, and how that process works. I think that would be really helpful for our listeners.
Yeah, sure. So the Madison, the claim process is, if you think about these types of risks, business interruption. So when a business loses revenue, they'd like to recapture the net income loss from that revenue or any overhead costs covered with the loss of that revenue. That's kind of what the Madison policies will do. The claims are all administered by Gallagher Bassett. Madison International uses a third-party claims administrator to process all their claims, and when a claim comes in, Gallagher will first backdrop that against the policy to see does this meet the definition as a valid and binding claim. If that gets approved, then there has to be the insured has to show proof of loss of revenue, right? It'd be like me calling up Progressive and say, "Hey, I just had a fender bender on my car. I'd send me a check for $2,500." Well, no, we need to assess the damage. I'd say, no, just trust me, right? We have to go through the same process at Madison. They got to show proof of loss of the revenue to Gallagher. If the claim gets approved, then the claim will get reimbursed. We actually have a client that's been with us now for 12 years. And it was a company that they secure mortgages. They're a lender, and they had they have offices all over the country. And they had an office, their home base is in New Jersey. They had an office in Denver that was being run by a key person, and that key person up and just walked away, decided to open up his own shop, and took all of the clients in that geographical area and took all the employees there with them. And so they submitted a claim because they lost revenue outside the control of the business owner. And that ended up being a valid claim, and it reimbursed back $1 million back to the mortgage company in New Jersey. And I can tell you that the owner of this mortgage company, the ultimate owner, said, "I am never going to file any claims. I'd like to have that underwriting profit and recapture that underwriting profit investment income." But this happened in 2022. And we know what the mortgage industry was doing in 2022. It was sucking wind, right? Interest rates were going up and people weren't refining. They weren't buying homes. They lost revenue, and that money came in. He picked up the phone and he called me. He said, "If you got anybody in your program that does not think this is insurance, that this does not pay claims, have them call me." And so he re-upped last year and bought more coverages. So that's the process, right? And we've actually had people that will send in a claim that's not even close to being a valid claim, and those get denied, right? Our job is to protect the pooling and the integrity of the program, right? And we will do that. But that's why we use a third party claims administrator. But that's how the claim process works.
Just like a regular insurance company, that's how they all operate, just like Madison does the same thing, which is why I want to make sure that's clear to the listeners. It is a real bona fide insurance company out of Puerto Rico, which has been around for a long time. One quick question I know this pops up all the time. Have any of the folks that own the segregated asset plan, the Madison program, ever been audited by the IRS and was ever denied any kind of deduction?
Of the ones that we know, and the reason I say that is Aaron and I were on a call with an advisor last year, and we were on with the client CPA, and they had some doubts about the program as being real insurance, and they asked if we ever audited, and we said, well, we had a few that have been audited under the Madison Puerto Rico program with no change, no adjustment, no deficiencies. And the advisor goes, oh yeah, well, we just had 2 of our clients this year get audited, and they passed with a no change. And Aaron and I were like, why didn't you tell us? What? Because we didn't need to. I mean, the IRS agent viewed it as an insurance transaction, and it was. So the ones that we know of, we have not had in the Madison program, have not had any change or deficiencies found by any audit.
Yeah, that's important because, as I said earlier, when we present this to the team of advisors who are not familiar with this particular program, that often comes up in the conversation, and it's always been the case. You guys have always done a yeoman job of preventing mistakes being made with these type of structures. And it's been very, very positive for everybody's.
Can I add one? I think one really important thing here is going back to these IRS final regulations is that when they proposed the regulations back in 2023, they came out of the proposed regulations say if you're an 831B captive and you own more than 20%, you don't have 65% losses. There were a lot of, if you borrow money out of your captive, then you'll be either a listed transaction or be considered a transaction of interest. Whenever the IRS issues proposed regulations, they allow for public comments. One of the things that they put in the proposed regulations was a line that says, if you meet all this criteria, you're subject to these, or you're substantially similar. And they never really addressed what substantially similar meant. And our outside counsel, who happens to be on this phone, Aaron Quinn, actually submitted in the proposed regulations during that submission time, if they could clearly define what they mean by substantially similar, because we get caught into that with some of these, you know how I am about CPAs, they're down on what they're not up on. So we wanted that clearly defined, and they clearly defined it in the final regulations. And I think, Aaron, if you don't mind, just say what they clearly defined, the right line test of the substantial.
Yeah, so the answer is that they said that in order to be subject to these regs, you have to have an 831B election, and obviously, like I said earlier, Madison does not. But they provided context as to why they made it specific about 831B. The election is because they acknowledge that the low probability, high severity risks are real insurance risks. They are insurable. It's totally appropriate to have coverage for those risks. And they also acknowledge that there are insurance transactions that have very low loss ratios that doesn't, like Madison does have. Madison has a 1% to 2% loss ratio each year. Having a low loss ratio does not mean it's not an insurance transaction. It's when you couple the low loss ratio with the 831B election and the more or less common ownership of the transaction on both sides of the equation here. That's what the IRS is looking after, and that's what the government sees as deemed abusive, where you have an insurance company owned and controlled by the insured with very low losses that otherwise is tax exempt because of a tax election. The IRS doesn't like that, right? So Madison here has low loss ratios, right? But there is no tax exemption under 831B. There's no ownership or control of Madison by the insured, and that really is what exempts Madison or sets Madison apart from all of the abusive transactions that the government is looking to really attack.
Awesome.
Thanks, Aaron.
Yeah, guys, this has been great. Unfortunately, I think we're out of time today, but I really want to thank you guys for joining again. For you, Mark, and Aaron, it's always great to talk to you. So thank you both. And yeah, I mean, we're excited to see where Madison goes from here. It's I'm sure a pretty crazy time for you guys, but I think it's all good. So again, thank you.
Yeah, thanks, gentlemen. Always a pleasure.
Yeah, thanks, guys. Appreciate it. Thanks for having us.
Absolutely, guys. Thank you.
So if anybody has any questions about what you guys were discussing today, how do they get in touch?
Oh, well, I'll defer to you guys, Mark or Aaron. What's the best place to get in contact with you?
Yeah, any questions, comments with regards to the structure itself and our history, contact me. And then if it's any legal or taxing information, we'll bring in Aaron, as Aaron is our outside counsel on all things matter with tax and legal.
So what's your email, Mark?
Or you guys are on LinkedIn, right? Or I think as well too. Yeah.
We're on LinkedIn. My email is msims, M-S-I-M-S, at, all spelled out, MadisonInsuranceGroup.org. MSIMS@MadisonInsuranceGroup.org. That's the best way to start reaching out to me, and then obviously we can go from there.
Thank you,
All
Mark.
right. Sounds
All
good,
right.
guys. Very, very nice job. And thank you all for joining today. And thank you for listening today. So please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the Truth About Wealth podcast. Click the subscribe button below to be notified when new episodes become available.
This material is for informational purposes only. Neither Osaic Wealth, Inc. nor its representatives provide tax, legal, or accounting advice. Please consult your own tax, legal, or accounting professional before making any decisions. Copper Beech is not affiliated with Osaic Wealth Incorporated. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Additional advisory services offered through Copper Beech Financial Group. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. These opinions are subject to change at any time without notice. Any comments or postings are provided for informational purposes only and do not constitute an offer or a recommendation to buy or sell securities or other financial instruments. Readers should conduct their own review and exercise judgment prior to investing. Investments are not guaranteed, involve risk, and may result in a loss of principal. Past performance does not guarantee future results. Investments are not suitable for all types of investors. Any opinion expressed in this forum is not the opinions of Osaic Wealth Incorporated and have not been reviewed by the firm for completeness or accuracy. Osaic Wealth Incorporated and Copper Beech Financial Group are not affiliated with any other named business entities mentioned.